lay of the land right at the word go. Sanjay Mookim is our market master today. He's strategist head India Equity Research at JP Morgan India. Sanjay, great to have you with us here on the program. Thank you very much for your time. How are things set up, Sanjay?
Good morning.
Are you a little more constructive as we start this year? Or are you of the view that after the very strong, relative strong year we've had in 2022, this will be a muted one?
Good morning. It's great to be on the show. I think the key is the relative performance. And, even last year, India, the index was within a 5% range on a YTD basis. But what you have seen is a significant outperformance of India versus EM, principally driven by the problems we had in China last year. That is now reversing, and it's a fairly obvious trade. It's been obvious to all our investors for a while that as China reopens and the economic momentum in North Asia starts to come back, the big trade globally in EM last year was to go long India, short China, and that is reversing. So from an investor interest, investor feedback point of view, that focus is shifted entirely to North Asia, to China. If you look at the market there, it's going up every day. The stocks arguably there are still cheap. And that is why we're seeing this incremental pressure on India. It is underperforming EM as China reopens. And this momentum, I think, at least in the near term, is likely to continue because the China reopening is still a process. It's not completed yet. There's probably still a lot more legs to go, both on the economy and the market. And until that sort of settles, I guess this phase of India remaining under pressure, a lack of interest in India is probably going to persist.
Okay. So when you say India remaining under pressure, Sanjay, good morning, Happy New Year to you. There are so many imponderables, right? I mean, there are higher rates, there is inflation, there is slowdown in growth, there's an impending recession as well, and we have the budget that's going to be thrown at us very soon. What do you see as the big trigger for the market, which could perhaps cause a turn in sentiment now for the upside?
Good morning, Happy New Year. I think I'll focus my answer on the global macro there, Sonia, a bit. Because what we're looking at through 2023 globally is slowing growth, across the world, in the US, in Europe, and possibly in India as well, accompanied by slowing inflation. And we're seeing this in data almost every time a new release comes through. Inflation numbers should continue to slow. But what we fear is that global central banks, and especially the US Fed, is not going to pivot so soon. That what the whole market is waiting for is dovish commentary from the Fed, which leads to rate cuts and possibly liquidity injection at some point. And we think that you will need to see some sort of market action, some sort of panic in markets before the Fed starts to pivot. And therefore, I think the biggest event in the life of Indian markets as well through 2023 will be the global monetary policy cycle, and the point at which you firmly believe that the tightness in policy is over, and you're now looking to some sort of dovish or monetary injection or rate cuts in the back half of this year. We can talk about the budget, but I don't think that's going to be a trend changer for the Indian markets, to my mind.
All right. Hi, Sanjay. Morning. The first few numbers out of the blocks were the IT names. How are you all reading it? You all have been fairly cautious on the space. You believe it has more downside?
Yes, we've been cautious on IT for a while, and this again starts with our consistent view that the global economy is slowing, especially in developed markets. So as companies in the US and Europe find it a tougher working environment, the growth in their IT spends is very logically going to slow. The debate you have with investors is whether this is in the price for the stock of IT companies. Are multiples low enough? And that's what we argue that they aren't. I mean, for many of the companies, they are either at or still slightly above pre-COVID valuations, whereas the top-line momentum is still slowing. And what we also debate with investors is whether the companies will be able to expand margins into slowing top lines, because that is what is forecast. That is, consensus estimates believe that IT companies will be able to restore their margins even though top lines are slowing, and that's what we are very nervous about. So neither the revision cycle nor the valuations are in favor for us from an IT pack, and therefore we stay with our negative view on the space for a while.
Sanjay, are the revisions argument in favor for the broader Nifty index or for the broader markets or stocks under your coverage? Or you think that is also, there's a bit of a question mark there as well? And revisions higher?
No, it is. I see what
yeah.
Yes, I understand. Look, we saw that upgrade cycle in India as the country reopened from the pandemic and the lockdowns. That has ended a couple of quarters ago. The misses are actually broadening, and this is, of course, to do with two things. One, expectations are too high because the market went up, valuations went up, so forecasts went up, whereas the economy is now getting into a more steady state growth phenomena. So it's a fault of, I would say, sell-side exuberance or market exuberance and the economic momentum as well. But I don't see a return to upgrades anytime soon. In fact, launching into our year-ahead outlook, we are struggling to find broad business themes or broad sector basket which can argue for upgrade. At best, what we can say for a few sectors in India that the downgrades won't happen, but we don't see the cycle that we've seen in the last 2 years from a revisions point of view, a positive revision point of view.
Okay. There are some themes which are doing quite well, right? In the meantime, by the way, we're getting a good update from Kolte Patil, the realty maker, on the Q3 updates. Realizations are a bit on the lower side, but otherwise the numbers are looking quite good in terms of sales. The pre-sales data, collections have gone up, and the stock as well is up almost about 2% odd. Some of these themes have played out really well, Sanjay, whether it's defense, the electrification theme, electrification and autonomous vehicles, that is. Then you have renewable energy, you have real estate that has done very well. From this entire basket that I mentioned, anything that stands out for you as a multi-year upcycle?
Yes, there are 2 or 3 of these things that we like. We really like real estate, and we've been long our real estate view for quite a few quarters and now. We've argued that the increase in mortgage rates is absorbable in a way that, the affordability of houses has improved significantly because incomes have risen and prices have been flat to down, and that consumers and mortgage buyers may be willing or able to absorb whatever raise in mortgage increases we've seen. And I continue to argue that the real estate upcycle will stay for a while. It is, of course, a smaller sector in the context of the overall index and market, but that is a cycle we like. If you give us a longer-term horizon, then we like the light manufacturing industries in India, right, which will benefit from manufacturing gains to India, which will benefit from whatever government subsidies are being provided. But this is something that you have to be patient about. It doesn't happen in a quarter or two. But we can see in data, we can see in the trade data that India's light manufacturing industries, which could include auto anchors and many other things, are structurally gaining market share over time.
Sanjay, the hope is from an Indian bullish perspective is hopefully, class is permanent and the form is temporary and India bounces back. That's the equity markets. But what about metals? China is going to be reopening, and we had a guest earlier today that said that they'll give them 15 on 10 in terms of rating them on the reopening out there. If that's the case, the metal stocks will be in focus out here. And a couple of data points suggest that maybe, in fact, they could be good for more. As a house, you're bullish, right?
We are. We are bullish commodities in general globally. But I've been a commodity analyst for most of my life. And, frankly, picking cycles and picking tops and bottoms in prices is extremely difficult. Yes, the stocks are working because prices are rising. This could partly be because of the sentiment of reopening of China rather than the real demand-supply action. We will find that out in some time. But the debate, I think, for these stocks is that you cannot trade these on valuations. You always trade them on the momentum of spot prices for the commodity. At the moment, it looks like it will continue. But the risk to Indian estimates, to answer a previous question as well, is that most forecasts for India assume low commodity prices. And therefore, there is a margin expansion forecast for many Indian companies. So if you, on the one hand, believe that the cyclical trade on metals or commodities is likely to continue, we actually then, at the same breath, start to get a little bit worried about the margin outlook for many companies.
All right, Sanjay, we will, of course, speak to you at a later date, but it was a pleasure talking to you on CNBC TV18. Thanks a lot for joining in, and have a great 2023. Well, let's move on. HCL